Hey guys, what's up? I'm Erin and welcome back to the channel. Odds are when it comes to a credit score, you know you want to keep yours as high as possible. Most traditionally, credit scores range from 300 to 850, and the average credit score has been on an upward trend for about the past decade, putting the typical person right in the good category. Now, having a good or even a great credit score comes with a lot of perks. What first comes to mind are interest rates and loan terms. Having a high credit score gets you the very best interest rates, which in today's higher interest rate environment is increasingly important. Locking in lower interest rates will absolutely save you tens, if not hundreds of thousands of dollars over the course of a life of a loan. Commonly, you probably think of your credit score coming into play when you're buying or refinancing a home, getting an auto loan, or maybe just getting a new credit card. And yes, these are very notable times in which your credit score comes into play, but they're certainly not the only times in where your credit score comes into play. In fact, your credit score has a way of impacting your day-to-day life in ways you may be unaware of. Let's first talk about the costs associated with a home. If you're buying a home, your credit score affects far more than just that interest rate. It affects the ongoing costs associated with the home. Perhaps you've heard of PMI, or private mortgage insurance, an added expense that's tacked onto your monthly payment if you put down less than that traditionally recommended down payment of 20%. And the fact of the matter is, most home buyers are putting down less than 20%. The average first-time home buyer puts down just 6% of the home's price. And for repeat buyers, that average sits at 13%. So many buyers end up paying PMI, and that PMI that you pay is directly related to your credit score. Typically, it's 0.58% to 1.86% of the original loan amount. And you guessed it, the percentage that you end up paying is influenced by, among other things, your credit score. Let's say you put down 10% on a $400,000 home. So $40,000, and that you have a credit score of 650. Your PMI would be about $500 a month, and you're on the hook for that PMI until you hit 20% paid on that loan amount. In this case, with a 30-year loan, that would add an additional $44,000 to your payment. That's an astronomical sum. But if we have the same house, a $400,000 home with a 10% down payment, a 30-year loan, but this time with a credit score of 780, well, now the PMI would be closer to $174 a month and cost a total of about $15,000. That's a huge difference. There's a PMI calculator linked down below if you're interested in checking it out. I'm gonna be honest right here, my husband and I bought this home, our first home, and only put 10% down. At first I was thinking I had to put the 20% down in order to avoid paying PMI. I was thinking PMI was going to be incredibly expensive, and I care what happens to my dollars. I don't wanna be spending a couple $100 every single month when it's unnecessary. But I asked the lender if he could run the numbers on what our PMI would be if we just did 10% down. Turns out, $20 a month. Honestly, I was floored. $20? That's it? Not to say that I don't care about $20, I absolutely do. But there's a cost to me putting down an additional 10% to get to that 20% mark. In our situation, an additional 10% would have been $36,500. I would have had to take this out of the market. That would have resulted in a tax consequence. There's also an opportunity cost in the form of lost interest. And being that this isn't our forever home, it's a home we're going to be in for a relatively short period of time, we decided it would be wiser to leave that money invested and instead pay the PMI. Now, does that mean that is the right situation for everyone? Absolutely not. Everyone's situation is different. But in our case, this was a very low amount for a brief period of time. And full disclosure, we both have credit scores somewhere around 810. And keeping with the theme of the home, your credit score will largely influence how much you pay in homeowners insurance. Now, they don't directly use your credit score, rather they rely more on your credit history. And they use your credit history to create what's called your insurance score. And a better credit history equals a higher insurance score. Policyholders with higher credit-based insurance scores might be more likely to pay on time and avoid lapses in coverage. They might also have the resources available responsible to maintain their homes, which could lessen the likelihood of needing to file a claim. To compensate for the high risk of claims and lapses, insurance companies tend to charge higher premiums for policyholders with lower credit-based insurance scores. And while these insurance companies might not technically use your credit score, here's the components of an insurance score, and they're gonna look mighty familiar. Previous credit performance, outstanding debt, credit history length, pursuit of new credit, and credit mix. So predominantly, to get the best interest rates, you need all the components of a great credit score. This shows that you're a responsible borrower and thus a responsible person to insure. This insurance score is also used when calculating your auto premiums you pay on your vehicle. It is worth noting that 3 states, California, Maryland, and Massachusetts, are banned from using your insurance score as a factor in determining your homeowner's insurance premiums. And 4 states, California, Massachusetts, Hawaii, and Michigan, do not allow lenders to use this insurance score for your auto insurance. But it is common practice to factor in your credit history when it comes to the other 47 or 46 states respectively. Keeping with the housing theme, don't think you don't need a great credit score if you're a renter. Most landlords do run credit history checks, and they use this information to determine if you're a worthy candidate to rent their property to. They also use this information to determine what your security deposit will be. A lower credit score often equates to a higher security deposit, and a higher credit score often equates to a lower security deposit. Many employers will actually check candidates' credit scores prior to making hiring decisions or any decisions that are based on promotion. In fact, some employers will actually regularly check their current employees' credit scores, and a low credit score could be a factor for a job termination. Some firms believe that credit history is indicative of a candidate's future work performance. The idea is that a bad credit could reveal certain undesirable personality traits, like a lack of personal responsibility. Companies may assume that a person who makes late payments on their credit card may have a similar attitude towards work assignments and deadlines. Some research even suggests that people with poor credit because of too much debt might be more susceptible to bribes, turning them into a security risk. Now, of course, not all employers run a credit check. Common positions that do are in the financial services industry. Think accountant or financial planner or mortgage lender. Government positions, think military, TSA, or law enforcement, and then a lot of executive positions as well as lawyers. Just know that if you give an employer or a potential employer the permission to do a background check, they can also do a credit history check. And according to CNBC, 72% of employers do background checks, and 29% of those employers check credit reports. My husband is an active duty service member, and he's told me that they now do annual credit checks to ensure everyone is still in good standing in order to maintain their security clearance. Did you know the big name cell phone providers like Verizon or T-Mobile actually use your credit score and your credit history to determine if you're eligible for monthly installment plans on devices? If your credit score is too low, you're not eligible for these monthly payment plans on devices. Here's why that matters. You know those promotional offers where they advertise that you can upgrade to the latest cell phone model for the low price of $0 a month? Well, how those upgrades work is that you're generally locked into a new contract, and the credits for the new phone are given to you over the course of a 2 or a 3-year term length. And if you're not eligible for these monthly installments, you very well may just have to buy the phone outright. And phones aren't cheap. They're often well over $1,000. And I think if we all kept that price point in mind, we'd probably all be a little bit nicer to our phone, because I don't know about you, but I'm pretty rough on mine. If your credit score is subpar or you have a blemished credit history, you may not qualify for a loan on your own. Alternatively, the lending institution might suggest that you get a cosigner. And I think this is dangerous territory. First of all, the lending institution doesn't have faith that you can handle this debt on your own. That's the first red flag, and a reason that you should hold off until you're in a financially better position. I also think it's a really slippery slope to ask a friend or a loved one to co-sign on a major purchase for you. You're asking them to risk a lot, because if you don't take care of this debt, you leave them really vulnerable. You leave them on the hook for this debt. And we all know that financial matters have a way of adding an awkwardness to personal relationships or damaging personal relationships. So I just think it's best not to get other people involved. If you can't afford it on your own, you have no business asking other people. Credit card issuers absolutely care what your credit score is. A better credit score qualifies you for better credit cards, meaning cards with more favorable terms or more alluring rewards programs. And being that 47% of credit card users say they use a credit card simply for the points, clearly, this is a category that matters to many people. And a better credit score allows you to take part in credit card churning if that's something you're interested in, where you get to open new credit cards aiming to capture those alluring initial bonuses. And these points and bonuses can be a wonderful deal. Maybe they allow you to take a free vacation every year, or maybe they give you free upgrades, or maybe they simply give you cash back. And it's important to remember that credit cards have incredibly high interest rates. And no matter what card you have or what reward points you are gathering, you never want to pay a penny in interest. So if you enjoy using credit cards, that's great. Just make sure that you pay them off in full every single month. And if you don't pay them off in full every single month, you should not have a credit card. There's absolutely no reward points that are worth paying 20 or 30% interest on any amount. So even though you may not be in the market for a mortgage or an auto loan, that doesn't mean you don't need a strong credit score. Keeping your credit score high can actually reduce your expenses throughout the course of your entire life. It has an impact beyond what you traditionally think of. And a quick note about what a lot of people experience when they finally become debt-free. Say you make that very last auto loan payment, or you make that final mortgage payment. All of a sudden, you're debt-free and your credit score takes a bit of a hit. And being that your credit score is reflective of how well you manage debt, once you're debt-free, it's kind of expected that it takes a little bit of a hit. Don't worry about it though. Being debt-free is absolutely amazing and a good goal to strive for. And I don't think there's any point in trying to stress to get a perfect credit score of, say, 850. Once you get into the upper 700s, say around 790 or so, you qualify for all the best rates. You get all the perks that come along with having a fantastic credit score. So I think a better goal is to just aim to be in this uppermost category. You don't have to try to aim for that perfect 850. It doesn't do much other than give you bragging rights, so I don't really see the point. Do you know what your credit score is? How often do you check it? And would you be willing to share what it is down below? If so, leave a comment. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye.